Welcome back. Now at the half-year mark, Sasol has seen a 34% evaporation in headline earnings per share. This as the chemicals and energy group had to contend with higher costs while oil and petrochemical prices were subdued during this period. Despite this, a dividend of R2 has been declared, albeit sharply lower than that of the previous comparable period. Company CEO Fleetwood Grobler joins us with a closer assessment of this performance. Fleetwood, a pleasure. Good afternoon to you.
Good afternoon to you.
Maybe we can start off with the top line. We know that it has been a low commodity price environment. How has this fed in to your income statement?
So if I look at the various business units, and I'll walk you through the various segments. So when I start at mining, we've seen an increase on volume through the bank of most of our business units. But the key issue that we found is that on the pricing side, we've seen some severe headwinds. So whilst on mining, we've increased our export volumes by 16%, we had a headwind of around 59% on pricing that reduced. On our gas business, very similarly, we've seen a 10% improvement on volumes, but we had, whilst prices in rand stay flat, the cost increase on a dollar-based feedstock input increased by 17% if you take the translation cost and the dollar-based cost. So that impacted the gas business. When I look at the fuels, we also had an increase of 8% on a volume basis, but on the cost side, there was a 15% increase. Our Chemicals Africa business increased on volumes again by 3%, but here is the big headwinds we've experienced. On the pricing side, we've seen a 21% reduction in pricing on the comparable period. The same in the US, whilst we improved volumes by 12%, we had a 28% reduction in pricing. In Eurasia, this is the only area where we have not increased volumes. We had a 4% reduction based on very weak demands for chemicals in that region, and we had a 23% reduction in pricing. Altogether, this then translated in the income statement to the EBIT that we posted, EBITDA of 28 billion, which is a substantial reduction, but we are pleased with on the areas that we focused on in terms of volumes that we could increase that and contain cost within inflation, and some areas improved on inflationary costs.
I must ask you, Fleetwood, as we mentioned, these costs, it's obviously been a high cost environment here. Are we expecting some of these to be once off flowing through the financials as there's some sort of recovery in the macroeconomic environment? And are we expecting some of these costs to maybe take a little bit longer to work their way out of the financials?
Yeah, so we've got a very focused Sasol 2.0 program that is focusing on taking costs out, improving gross margin, looking at our capital and working capital. So that program is in mid-flight. We are focusing on to conclude that by our financial year 25, and we've reported quite substantial progress over the last 2.5 years on that program. So the focus on cost and capital containment is relentless, so we will continue with that. We've also seen some stabilization of market headwinds in our chemicals business. Quarter on quarter in Chemicals Africa, we've seen that the pricing have stabilized quarter 2 versus quarter 1, actually a slight increase. So we're hopeful with the focus that we've got on the areas that we control with respect to costs, capital and volumes, that we will maintain a key focus on delivery on those aspects in the remaining part of this financial year.
I'd like us to please also touch on just, I think, for two items that were highlighted in today's sense, the issue of the purchasing and sales agreement area, as well as the impairments in Secunda.
So the first one is that we have indicated the impairments coming through. That's based on the remeasurable items that come through the income statement. Our focus is much more on getting a sustainable view on delivering EBITDA, and that will be driven on our focus on margins and cost and volume. So in that regard, we believe that those are the things that we can control, but the items that play into impairments that considers the macro conditions, pricing, long-term outlook in certain segments of the industry, those are things that we need to deal with as they come through.
I also want to ask about the balance sheet strength and overall Fleetwood and how you're feeling about, the quality of assets that sit on the books, but also from a debt perspective.
So we've seen a 1% increase in our debt to $4.6 billion net debt. So whilst it's stable, and we know that in our first 6 months, we usually have a higher capital spent with our shutdown in Secunda, we've also seen quite a movement in working capital that came through the balance sheet. So our free cash flow for the first 6 months is under pressure. And we do believe that we've got confidence that in the second 6 months, we would deliver better on free cash flow. Of course, the priority will be then to focus per our capital allocation model to do our maintenance and sustenance capital. Then we will consider any capital available for a dividend or then discretionary for payout in terms of dividend. And then last but not least, if there are any consideration left, then we'll also consider capital for growth. So whilst we have not seen much movement on our net debt reduction, we believe that in the second half, given where macros is heading, we've got a fighting chance to stabilize and maybe to reduce some of that debt.
I'm keen to also find out about research, development, new technologies, and how much, we're being allocated to these amounts. So considering that we know that Sasol has a long-term view of maybe overhauling operations and making them more green.
So we know that technology is core to Sasol. So the programs that we focus on enhancing our Fischer-Tropsch technologies, our catalyst development areas, those are the areas that we prioritize during times like these, because we know that that is really ensuring that we've got a solid platform for the future. And so it is a matter of prioritizing the areas of spend and focus, and that's exactly what we're busy doing.
I must also ask you about the issue of natural gas and that 2026 deadline, Fleetwood. We've had quite a few, players who rely on Sasol coming through to speak to the media about their concerns there. Just help us understand from Sasol's perspective where we are and what the best way or course of action is today to ensure that we are ready for that 2026 deadline.
So as we've indicated to the market, our gas fields that we started to flow in 2004 is in the decline. And so we've signaled to the market that the PPA gas field that was the source of gas that supply the industrial users in South Africa will be declining from that period. And we've given that as a heads up so that there's ample time in preparation to mitigate that decline through other sources of capital. We're very pleased that in November that the DTIC has convened a forum to look at bringing gas into South Africa. It would be LNG, so to play the role of aggregator so that everyone can come in and participate in this offtake of future LNG gas and that we can plan for that. So the DMRE, the DTIC, all the government areas are very cognizant that they need to step in because Sasol's balance sheet cannot be put up to secure all the gas that has come in from sources outside South Africa. And so the customers and the current users of gas need to come to the table also to put up their commitment for those future gas, and they have to assess the affordability of that. But I'm very pleased to see that the government has really helped us now to create that platform so that we can start to aggregate the needs and then take it from there to timeously bring in gas that can replenish the gas decline out of our fields in Mozambique that currently supply this customers and need users.
With that said, Fleetwood, please help us look ahead, maybe helping us with guidance and the outlook for the remainder of the financial year.
So we know that the second half of the financial year, from a volume point of view, will be probably stronger because we've got this maintenance outages and shutdowns normally in the first half of the financial year. So we have given guidance today in terms of our volume still out of Secunda is going to be in the range of the 7 to 7.3 million tons. We look at our chemicals business, we maintain the guidance that we've given at the start of this financial year. So I believe that in terms of the outlook, we hope that volume would be within those guidance, and we hope to see stabilization in some of the commodity areas, whereas the chemical cycle is the lowest, and it's below the lowest that we've ever seen. And we hope that stabilization will start to settle in this year, and hopefully by the end of this year, we can see the market turning for the better in the future.
Fantastic, Fleetwood. It's been a pleasure hearing from you. Thank you so much for speaking to us this afternoon. That was Sasol CEO Fleetwood Grobler.